Hey, everybody. Welcome to week 113. At some point, I'm not going to be able to count that high. So you know what to do. Hit the Q&A. You can harass us on the chat. And I am wearing the first piece of BGW wearable swag that I have been given because we did a community service day at Samaritan's Feet. And if anybody has never been out there, that is a cool organization that gives shoes to people that don't have shoes, need shoes, domestically and internationally. It's really cool. So a shout out to Rachel Coughtry and the team for organizing that. That was a boatload of fun. And next time we're going to turn it into a legitimate competition between tables because we had an informal one going on and the girls beat us. So just so you know, they had the system down. So anyway, so today we're going to go into a number of things on, especially on tax implications and tax planning if you're buying or selling a business. And the best time, it's kind of like planting a tree. The best time to do it was years ago. And the second best time is now. So anyway, that's where we're going to go. And Jack, I love your background.
Yeah, I need to learn how to get it smaller. So again, we can have the subliminally overt with our logos in there. And, you know, it says week 113. So obviously the computer zoomed in to the center of that graphic that was on our LinkedIn and Facebook for today's session. So I guess to start out, in continuance of the Cliff Clavin discussion that we had last week, I was, as I'm reading, I'm thinking, oh, that'd be something interesting and maybe other people don't know. So I'm going to share a few things, current events that I read that I thought might be interesting that are kind of out of the mainstream a little bit to basically share with your dumbasses who don't read the newspaper. So and I'll tell you why I said that in just a second. All right. So the first thing is.
Yeah, that's kind of out of character for you.
Yeah, I know. Right. Yeah. I know it shocked you. Your heartbeat rate's probably like going like this, right? All right. So first article, why you should swear in online reviews. There's a limit, but a little profanity can go a long way to get your point across. And so it was an interesting article. I mean, the whole 1.5 pages in the Wall Street Journal, and it comes down to what makes them so useful to readers is that the value of swear words comes from the unique ability to convey 2 points of information, one about the reviewer and another about the product under discussion. So basically what you're talking about and the person who is doing the talking. The readers infer that the reviewer felt more strongly about the item, the item was, whatever it was. And so it conveys the feelings of the person who's saying that. So that's why.
Okay. So time out.
Yes.
You need to reveal that the author was Howard Stern. I mean, put it in context, Jack.
Yeah, since Gary weighed in, I was going to let Jack finish, but it's funny because I have really tried to reduce the amount of swearing that I do. I'm not always successful, but I have read similar articles, whether it's, hey, smart people and more honest people swear, because it's like, I just want any justification for me able to drop F-bombs anytime that I want to. When that happened to think about it, it's like, it is really hard to not swear when you're a swearer. Like it's really, it's hard to retrain your brain to not, drop a bunch of F-bombs. So, hats off to the author for just saying, no, let's make up an excuse why I can.
Yeah.
So
thanks, Howard.
I'm gonna keep trying to get my goal. When I say my goal, it's not like I'm saying, if I could really cut back, to 5 swears a day, that'd be really, it's more like I have a 0 swear policy and I don't always live up to that expectation. But I definitely have used all these justifications before when people, man, you swear a lot. I kind of, it's like, well, you don't know where I'm from. This is the way they always did it up at GM when I was in meetings with them. If you didn't get 5 F-bombs thrown at you and then thrown out of a meeting, you weren't trying hard enough. Like, not really. I mean, that really did happen. But doesn't mean that the same point couldn't have been conveyed without the F-bombs.
Yeah.
Well, I reserve my swearing in two situations. One is, and my excuse for doing it with my kids, which is not very often, is for
I do that too. Yep.
One is to convey how I'm feeling about a certain situation when they are acting like dumbasses for whatever reason. The other is so that, and I'm allowed to say this because I am half Italian, is that when they're around certain family members or other people who that is part of their everyday language, is it's not to convey anything. It's just it is an adjective in their vernacular. Then that I want my kids to not be shocked when that happens. So and the other situation is with fraternity brothers and my sister-in-law who married one of my fraternity brothers. When usually after a couple glasses of wine, then there's some interesting conversation that goes on. So, okay, next thing.
That was a rabbit trail of rabbit trails. I'm just going to say
It was.
Yeah.
This is the very tangential 113th version of this program. So next thing is you need to be aware of the fact that you may have to bring your own stuff into the movie theaters because apparently there is a popcorn shortfall, which is going to be the spoiler for summer movies. I admittedly will maybe go by the CVS and pick up some Reese's Pieces and stuff and very carefully wrap it and keep it at a certain angle so it doesn't rattle back and forth. So, I mean, there's a technique to it. So be aware of that you're may have to, bring your own food. Something a little more serious is that adjustable home loans are returning. Apparently those rates are a little bit lower than fixed because of the mortgage crisis that occurred back in 2008, 2009. That there's a lot more care put into this. In other words, the credit scores need to be higher. What they were doing is with the interest only loans, if you recall from a little over a decade ago, was low interest loans. It was, anybody can get this stuff and it was affordable and your credit rating didn't have to be that much because you didn't have to pay that much. But then when the principal, the P&I kicked in, and sometimes they were waiving mortgage insurance as well. So, all those things kick in and then you have foreclosures, you have people going into bankruptcy and those kind of things. So word on the street is that those are coming back, but with a little more care. We've been talking about kind of the return to the office kind of thing and what people are doing, and then just information. So, I'm about statistics. So recent polling of office workers supports the analytics that 52% of those who want to work remotely listed avoiding commuting as the top reason why they don't want to go to the office. So that seems to be people are used to not getting in their cars, add inflation, gas prices and everything else. So just another reason that is happening. And one of the effects of that is if you're a landlord or own property that, okay, it was easy to say, all right, we'll throw a little tenant improvement allowance in there. We'll paint the walls. We'll do this. We'll do that. Tenants are now expecting a lot more from landlords. And in the extreme, on a larger commercial side of things, when companies are building buildings and those kind of things, there are expectations now by the city, the county, whoever controls the public areas to build more infrastructure around that, whether it is the road, whether it is sidewalks and those kind of things, which is the way it's always sort of been, but there's more emphasis on them doing that. And then finally, there was an article about advertisements and using dogs or cats in the advertisements, which is better. And the reason why I thought this was interesting is, and it kind of makes sense, and I wish I could have gotten a minor in psychology when I was in Chapel Hill, but they didn't offer that. But I'm a people watcher. So what they did is that they put an ad, they had two groups. One viewed a commercial. There were two groups, but there are two commercials. No, wait a minute, four groups. Two with dogs, two with cats. Control group one, article about sneakers or tennis shoes, athletic shoes. And it was that and one with a dog, one with a cat. And the promo was do better at athletics and, be able to be more athletic kind of thing. And so, and then they said the the price is $50, how much would you pay for those shoes? When the message was be more athletic and active, the price for that was offered for on the dog commercial was $33.74. And the cat group bid $28.23. Take two different groups, dog, cat, and the message now is our shoes are made of synthetic material, which is anti-skid and reduces the possibility of foot pain. Okay, so not athletic, it is calming, right? So it flipped. The cat people would pay $32.45 and the dog people would pay $28.40. So the message there is that, and they talk about the ad conforming to the stereotype of the image that is portrayed in your mind when you hear certain words. So athletic versus calm, dog versus cat. And so when the dog people heard the calming thing, it really didn't trigger them, and it was less valuable to them, kind of thing. So, which again, psychology makes sense, but it was just interesting. You know, I've always thought that, okay, hey, that's a cute little dog or cat. And, you know, but really, did that influence your decision whether or not to buy the product or even pay attention to the commercial? So anyway, again, an expanded Cliff Clavin version of interesting facts, which will not make a material difference in your life, but are just interesting.
Cliff Centinello, thank you very much. I think we're dog people at BGW. What do you think, Adam? Especially with you.
Yeah, that's funny. Yeah, and I, just reconfirming that, we're all subject to somebody else's lab experiment. Anyway, yeah, I'll go get this. Anyway, yeah. So what I had for today before we kick off is that, on the radio this morning, they were on Charlotte Talks. They were interviewing Mark Bittner, who a lot of us in town have heard, and then two other economists, just talking about inflation, interest rates, and stuff like that. And I thought they did. We hit this on the last webinar, but I thought they did a really good job of explaining some very difficult concepts. And first off, why do we have inflation? It's because you have a lot of money that was pumped in as part of the stimulus. To put it in context, $5 trillion has been put in the economy as part of the pandemic relief. When we were in the Great Recession under the Obama administration, it was $1 trillion. So 1 trillion versus 5 trillion. So it's a lot more money chasing not an increased number of products. So basic economics, whole bunch of people trying to buy stuff and there's limited scarcity, prices go up. So thank you for the reminder, Mr. Bittner, on that, of why this is occurring. So with interest rate increases, the thought process behind that is that if you raise interest rates, then Gary doesn't want to spend his money anymore. So money stops chasing scarce products and has a chance to kind of catch up. Like it reduces the money supply because Gary's not spending his money, he's spending it on his mattress because interest rates have gone up. He's not buying houses, stuff like that. So that was point number 2 that I thought, okay, that's pretty helpful. So, generally, what they were, their argument was, there's no good probable outcome here, in the sense that, if interest rates are raised to try to reduce inflation, that's like a multi-year fix that kind of puts the growth rate of the U.S. economy at like 1.5%. But you can't have any hiccups, otherwise you get dumped into a recession. It's like a big bad hurricane happens, another ice storm, anything happens, you kind of kick off a recession again. Versus going draconian on interest rates, meaning like, hey, let's really supercharge and raise them, could have the same impact. So what I took out of it is, just keep on using the phrase new normal, and it sounds kind of cliche now, but just accept the fact that we're probably in for a couple year ride of supply scarcity / higher prices / higher interest rates and a little bit of slower economic growth than what we've seen. Now, I'm not saying that to be doom and gloom, because we had clients that made, great money during the recession. We had some clients that were flat, and then some clients that went under, and the clients went under. Very few of them, they were the victim of circumstances. Most often it was just, they weren't doing the other stuff necessary to survive the downturn. So, and their balance sheets weren't very strong to begin with. So that's a long way of saying, kind of the takeaway from that is, we said it last week, saying it again this week, healthy balance sheet, meaning debt structure's right, working capital's right. Those would be kind of my improvement levers that I'd be focused on, kind of double down on customer relationships so you're not losing anybody. Even if you have to do some price increases, those would be my areas that I'd be focused on right now.
And I would say, Adam, relatedly to that is labor in two facets. So one is, so I asked my rising high school junior, okay, when do you start working? He's like, Dad, I got it under control. I'm going to go work where I worked at last year, which is a logistics warehouse where he's moving boxes around, essentially, he and his buddies. So it's fun. And I said, all right, so what's going on? He's like, Dad, look, if I don't get a job here, I'll get a job over there, literally. And he's absolutely true. That's absolutely accurate, which is there is a shortage of labor. Okay. So what happens then is you have to increase, and the wages that he's going to get this year are much different than, I should say much, they're higher than they were last year. Beyond what a normal increase would be, is because these employers, we employers have to pay more money for that. On the services side, you see things like, and we've tried to resist this, and we have so far, which is obviously our hourly rates increase. We have to pay, I shouldn't say this too loudly, we have to pay our associates more than we did last year, this year. And so, how do you account for that? Well, professional service providers are increasing their rates beyond what is a normal rate increase. And we've done a little bit of that, but not as much as we probably should, to cover those higher wages and higher salaries. But you're seeing that impact across the board. So when you hire, and I'm not talking about necessarily professional service, I'm saying any services, somebody come work on your yard, somebody to come work on your dishwasher, you're likely going to see higher rates than you did before, because there is the same demand or higher for the services, but less people doing it because they can choose what they want to do, and they can hold out for higher wages for an extended period of time, because they know they'll recoup that down the road if they get the right job and the right wages. So anyway, another tangent, but relatedly to what we should expect because of the way where we are in the economy and the supply shortage, and then the effects of inflation.
All right, so since we're on a tangent, I'm going to follow that theme for just a little bit before we dive into this. I was talking with a client yesterday who does a lot in home remodeling, and they do a lot in kitchen, well, especially bath remodel stuff. And they were talking about the need for weekly views on their dashboards because of this exact thing that you guys are talking about. Supply costs are just going up all the time, like weekly, and same way with labor costs. And then you also have this delay. It's interesting. One of their suppliers was my biggest client on my last turnaround in an insulating glass manufacturing company. And they are talking about 10-week delays now, up to 26-week delays if you have certain configurations, et cetera. And they were talking about the importance of just like, I can set the client expectation or the customer expectation, because they're homeowners. If you say it's going to be 20 weeks, I'll tell them 20 weeks, but don't tell me it's going to be 10 weeks and then it becomes 20 weeks. So that whole communication thing is a real important thing that is often overlooked in business and just kind of taken for granted. Oh, it'll be fine. No, it's not fine, because people have expectations, and especially in difficult times, the more you communicate and keep people abreast of what's going on, the more understanding I've found them to be. So just another thought. So now we're going to get into this subject matter that we talked about, which was, all right, what should I be doing? What are some tax planning strategies when I'm either buying or selling a business? So the first question that I'm asking both Jack and Adam, I want you to think about probably one of the most egregious examples that you've experienced where somebody came to you with their hair on fire. Oh gosh, I sold or I'm buying and I should have done something, but I didn't. What were some of the ramifications from lack of planning? Adam, first to you.
Yeah. So, I mean, it was a triple whammy. It was a C corporation that would have qualified for tax-free gain if it would have been a stock-based sale instead of an asset-based sale. And there was no consideration for the taxes. So if you do an asset-based sale in a C corporation, what ends up happening is, you sell the assets and the C corporation pays tax. And then you've got this big chunk of cash sitting in your C corporation that you need to get out. So you have to pay a dividend. You pay tax and dividend. So the effective tax rate on an asset-based C corporation sale, can get upwards of 55% before you're all said and done, between federal and state rates. So, they did this when in reality they could have paid zero tax. But what they did is they agreed, and in the agreement document, there was a transaction structure that was defined, and they couldn't get the buyer to, they already agreed to it. They couldn't walk away, and they couldn't get the buyer to offer them any consideration for either a tax gross up, which would have been, because that still would have been more money the buyer would have paid, or just, maybe change the transaction terms somehow for reduced purchase price in exchange for going the stock-based sale to then get tax-free gain. So it was just, that was a big deal. I mean, if you think about that, that's basically accepting half of what you could have gotten
Wow.
had you done some pre-planning.
So real quick question on that. If they would have come to you before they signed any of that, how much time would we have needed to get them in place so that things were structured to where they could have avoided that?
So I think we're pretty similar to what I've seen Jack do, which is, you try not to have any fire drills, but when you get an LOI, your hair's on fire and you really want to have a response to it. So I generally try to kick back, like, if someone sends me a letter of intent that they have not signed, that they're contemplating signing, or even if they've signed it, but they're like, hey, I signed this, would you take a look at it? I try to get those kicked around in 24 hours or less, because you want to go like early, versus, hey, I want to let you know, sold the company, we're in the middle of diligence, and they've got some tax questions. You're way too late at that point.
Yeah. Yeah.
Yeah, I would agree with that. That it's always a pleasure to see an unsigned LOI where you can have some discussions with the client who maybe hasn't considered those things. They just make an assumption. They've been told, well, an asset sale is better than a stock sale, or the buyer's requiring, it be an asset sale, free and clear of all liens, and et cetera. So let's talk about why, and let's make sure, and always involve the CPAs in, and sometimes they don't have a CPA who can handle it. That's the other thing too, is that, you have to have the right bandwidth and the right professionals helping you in order to get through this properly. I mean, I have basically suggested to clients that they fire certain professionals or reconsider when a professional is telling them something that I know to be not accurate. And then I go down and talk to my tax partners, and usually give you guys a call, or, and say, okay, gut check, is this, and then it's like, yeah, that's just not right, or they're not trying hard enough, or they're, whatever it may be. We talked about kind of the ignorance of just choosing an S corp just because that's the way it's been done. And, it's easier from an accounting perspective for both the business and the CPA handling that return, essentially. So there's that. The one thing that I'll share is from two different perspectives, but it's the same issue, which is making assumptions. That the buyer makes an assumption that everything is going to remain the same post-closing because he or she is going to run the business the same way that the seller did, and assumes that all the seller employees are going to be there, and that, there's really no problems. And that stuff gets kind of ferreted out in due diligence. But then there is, okay, what is the loyalty to this other person? So was the business to the seller, was the business really the seller, or was it kind of standalone? And so you extract the person. Are those customers going to go back to the business? That's an intangible and sometimes immeasurable factor, variable, but you try to get to that. And a lot of there are disappointed buyers after the fact when business kind of goes down in number wise and those kind of things. The flip side of that is that a seller makes certain assumptions with respect to things like earnouts. When you have an earnout, you certainly have set the table for and negotiated what the results of that earnout is, but you're not in control of the machine that is going to make the money that triggers those earnout payments to you. In most cases, sometimes you're there as a consultant. Sometimes you may have some influence post-closing as a seller, but there is that assumption. And so my initial inclination when I see an LOI, hopefully unsigned, is we talk about, what are your expectations post-closing, and that we really should focus on more definite numbers, meaning a purchase price with a set number. And it could be delayed payments, installment payments down the road if it's not an all cash deal. But when you start getting into variations of compensation of the purchase price that's based upon performance of the business after closing, to me, in the way I express that to a selling client, is that's the gravy. Don't rely upon that as being like, if you wanted to get $5 million out of the deal, and $1 million of that is an earnout, you have to be happy with 4 million in the worst case scenario. Now, you're not going to end up with 4 million, but you may not end up with 5 either. And so that $1 million delta is, to me, again, gravy, just it's a bonus. And I use lowercase b. It's gravy. And I think that you've talked about managing expectations today. That's another expectation that needs to be managed both on the buyer side and the seller side. And all the while you have potentially investment bankers and others in your ear saying, do this, do this, do this. You just have to kind of sort through and weave through that and really consider the variables and get those down in the LOI. Speaking of LOIs, there is a presumption that, okay, well, and I think we're going to talk, Adam and Gary and I have talked kind of internally about maybe putting together a series of the anatomy of a deal. And so that would include LOI, the transaction document, due diligence, and that kind of thing. But just a brief note on the LOI, which is most people presume that it is, and I even describe it this way, it is to make sure that the parties are in the same universe, ballpark, on the fundamental terms of the agreement, of the arrangement, which is price, how it's going to get paid, is there funding, the type of transaction, and other things, conditions precedent. a precedent to the consummation of the transaction, whether it's landlord consents and transfers of leases, franchisor consent, whatever it may be. In addition to the obvious things, which is no liens on the assets or assumption of liens and those kind of things, but in the LOI process. And so then it's a lot of times, well, Adam was talking about very quick turnaround on the LOI. One of the reasons for that is understandably pressure from external pressure on a buyer and seller to make sure that there is a deal in principle that is going to move forward. And you hear it, we hear it all the time, is that it's non-binding. It's just to make sure that you guys are in the same world, and just sign it and then go talk to your lawyers, then go talk to your CPAs and work out the details in the asset purchase agreement, which is mostly true. But there are things that, and I've done this, I said, well, wait a minute, that isn't what the LOI said. When it's something that's significantly different, that should have been, I think, discussed in the LOI. So, regardless of what side I'm on, and they start throwing stuff into the asset purchase agreement, the stock purchase agreement that are significantly different, and I think should have been at least mentioned in the LOI. But you get, okay, we'll just sign it and then we'll figure it out later because it's non-binding. That's problematic. If you have something, for example, a no shop provision in the LOI, which basically says you can't do, you seller can't go and talk to anyone else. Well, I mean, are you ready to grant someone a monopoly, a gag order, essentially, when there are still really some significant material deal terms to be worked out just to make sure you're in the same ballpark? Or are you going to punt it down the road, but yet still bill under a 90-day, 120-day gag order? So again, just some points, negotiating points, and some deal points.
All right, so another question, and audience participants, feel free to hit us up with questions, because this is a good time to do it. Otherwise, you can call Jack separately, and I guarantee you it won't be free. And same way with us. So take advantage of it. Also, just so you know, behind Adam is a picture of my family, except for we're missing one grandchild. That was before the last one. So whenever Adam talks, pay attention to that picture. That's my family. He's in my office because he was a good leader. He led by example, and he gave up his office to one of our colleagues. So anyway, so the question is, all right, so tax planning 101, before you sign anything, contact your CPA, contact an attorney that's well-versed in M&A deals. Number one, 101. 102 would be like, all right, let's say you're structured as an S Corp and you're going to do a deal and it may be private equity. What do you do? Like, structure of the company may have been a good thing, or maybe it was a C Corp, maybe it was an LLC. I would like you guys to talk about things that you can be doing. Let's say it was structured one way and it needs to be structured another way before the sale, depending on who's buying it, whether it's an internal transfer or an external transfer, etc. So Adam, I'm going to throw it back to you for kind of this next level of like, what should you do?
Yeah. So that I'm going to explaining what happens would get really wonky unless Jack has a way to explain it in a way that's much better than how I'm going to explain it. But, generically, what you need to know is that if you're an S corporation, you are not attracted to anybody. So one of two things is going to happen. Maybe a combination of all the above. Number one is they're going to want to do an asset-based sale. They're not going to buy your stock. But if they do need to buy your stock, then they're going to do a stock-based transaction, but do what's called a 338H10, which elects to treat it as an asset-based sale. That's not the end of the world. It just means that you're probably going to have some components of ordinary income that you weren't planning on, and the rest of it's going to be capital gain. But in private equity, the most common scenario is when they want to, they want to retain something, they do what's called an F reorg. I'm not going to get real wonky in terms of the tax code of what that actually is. I'm just seeing it's top of mind because I've seen like 4 of them in the last, week. Hey, they say consult with my tax advisor to make sure that, this is all okay, blah, 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 blah. But basically, what's happening in that scenario is private equity wants to buy you and they want you to still be part of the deal. So they want to get you new equity in the newly formed entity, which is really nothing more than your rollover equity. Meaning like, hey Jack, I want to buy you for $10 million. We're going to give you 8 million cash, $2 million of equity in this new entity that we're creating. That's really just your rollover. We're asking you to leave some money on the table and be part of the new organization. So the way they do that is, they set up a series of entities. You contribute stuff, buyer contributes stuff, you end up with your own holding company that holds your interest, but all the assets and everything else are now sitting in, a separate entity that most likely is going to be an LLC, taxed as a partnership. And the intent would be that if you follow the steps correctly, which is, you got to do some stuff almost said bad word. You got to do some stuff pre-transaction. See how hard that is? You got to do some stuff pre-transaction. And then there's some stuff that happens post-transaction. But generally, buyer and seller legal teams are all doing stuff to make that all happen simultaneously. At the same time, it's like, do this reorg, revoke the S election, do that, blah, 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 create this company. I mean, that's all usually stuff that's happening like the week of the closing so that all parties can guarantee that it's actually happening. But the point is, I don't want to get taxed on my rollover equity, and there's ways to do it that, you don't need to be concerned about unless someone doesn't bring up this complicated structure, in which case you'd say, how are we going to not make this taxable? Or do my Cliff Clavin, hey, Normie, how are we going to make this non-taxable? I'm terrible at Cliff Clavin. I got to get better.
All right, so same question to me, right?
Yeah.
So I think that, if we're we're in the middle of the transaction, that I think that there needs to be a cadence to the process, and it does get hurried at the end just because of necessity. And there are things that can be done on the front end from a legal perspective. There's some things that you really don't want to do until later, like a final UCC lien search. You may want to do an initial one, and most do, just to see what's there and to see what needs to be shaved off. And sometimes you'll see, oh, that loan was paid off 5 years ago, but Wachovia didn't. It's probably, the Wells merger was probably longer than that, so 10 years ago, and Wachovia didn't file the termination. So then you got to go hunt someone down in Wells Fargo and get it done. The other thing too, as far as reviewing balance sheets and reviewing financials, is so in an S corp, well, in other corporations too, or in any company, you have kind of ownership perks in closely held companies, and things like company cars, paying for fuel, going to Vegas for business meetings, those kind of things. And I think that what is helpful from a buyer's perspective, and most buyers and their professionals will go through this anyway, which is to remove those things, create kind of a more objective balance sheet, income statement that doesn't reflect those things that may or may not be operational assets or liabilities in the hands of the buyer. So maybe the buyer isn't going to continue with Hornets tickets or Charlotte FC tickets or Panther tickets, or whatever it is, those things that are more owner oriented, or options, or things that they chose to do. And so you get to I think a healthier balance sheet, income statement, financials that reflect what it might look like from the buyer's perspective, running the buyer running the company. Because I think it does get a little blurry as to what the true results are when you have a lot of things in there that are business development expenses that are really more kind of pet projects for the owners or others, kind of thing. Doesn't necessarily, it doesn't happen in all companies, but we see it enough that, if you're looking for a competitive advantage to, be more sexy to a buyer, is to start putting together your own analysis. The buyer will do it, but if the seller provides it and essentially admits that these are perks and options, and it may, increase forecast on revenue and obviously decrease costs to make you look better. So just some thoughts on kind of that next step, especially with an S Corp.
So while we're on the S Corp thought, there are a lot of clients that are structured as S Corps for tax advantages, and they make that work. But if they are not going to sell internally, and maybe an internal sale, keeping it S Corp makes sense. I'd like you to weigh in on that too, Adam. But what if you are structured that way? It seems to me like it's always a good thing to have a conversation, and this gets back into some of the stuff that we've talked about with succession planning, which is have a conversation with your closest and most trusted advisors, especially your CPA, not just because I work for a CPA firm, but that is really key, unless you like paying 55% taxes on the deal. But, having the conversation about, well, what do you want? What's the game plan and the exit plan? What are you thinking? Granted, there are opportunities, but like, what's in your head? So Adam, you've been through this so many times, it's not even funny. Let's say that somebody is in that S Corp situation. What do you recommend? Like, a couple years out, what are the things that we've talked about? You got to get your books in order and that sort of thing to drive the price of your company up. That's very important. But talk about structure conversations a little bit more.
No, actually, I mean, meaning I will, but I think, where I really would start that not a lot of people do, I heard, talking to a guy this morning, and he was just talking about, kind of the phases of your life, that you're in. And, it's more, this is more tailored from a guy's perspective, but it would also apply to women. It's like, half your life is really spent counting stuff, like counting kids, counting, do I have enough money for college? Do I have blah, 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 and then you kind of hit the point where, okay, I've got the counting done, and now I got to count something new. Well, counting something new is to make sure that you're taken care of, and that you can then move on into the next phase of your life, which is really, I don't mean to discount like what gets you to that point, in terms of, did you really live your life or not? Of course you did, but now it's different because your primary focus is not necessarily raising kids anymore. Kids are grown. You're in a different phase of your life. My point in saying all that is that, I really think the very first step, that needs to occur, hopefully years before you actually do anything, is really just deciding, how much longer do I want to do this? What do I want my life to look like? Do I want to die here? Or not, because, I think Jack and I probably run the gamut between business owners that sell it all at 50, 55 and are done and kind of work how they want to work. And then we've also had people that, are 75 and decided to sell so they could enjoy the last couple of years, without depression, the headache, or their spouse started to have some health issues. So they needed to, scale back a little bit. So let's put the business up for sale. But I think the first thing is just, really taking the time to get honest with yourself around, what am I doing? Honestly, like, what am I having the self-awareness to have an honest conversation with yourself and some, you know, people sometimes think that, you know, talking to other people is a sign of weakness. It's actually a sign of strength, you know. So asking other people, you know, if you don't have confidence, figure out how to get some confidence. You know, asking other people, what do you think that I should do? You know, how did this work for you? So you can start formulating that's it. Like if you haven't started there, then really it's not through just winging it. I mean, there are serial entrepreneurs that sell companies. I mean, there's opportunistic things that happen where, you know, unsolicited, Gary and I have a client that happened to. Unsolicited, I got to know why. Wow, that's interesting. Let me start thinking about it. But there wasn't any intention behind it. What I'm saying is the only thing you really can control is at least getting intention around the process. And the first step in intention around the process is figuring out, what am I doing?
I totally agree with that. I would look at it as when you decide to sell your business, you're going through a business divorce. You happen to be divorcing yourself. So you're taking the part of you that runs the business day to day, and you are divorcing it and selling it to someone else and putting it in their hands. And you have to be okay with that. Now, you know, whether it is to go play more golf, whether it is, you know, there are some that Charlotte Score or those kind of organizations where they have this skill set and they feel a obligation of community to go and share their blessings and their knowledge that they've acquired over time. There are nonprofits that are always willing to take smart people on that want to do work and have experience, whether it is financial, whether it is operational, whether it is HR, whatever it may be. And so, you know, whatever that next thing in life is for you. And sometimes the owner does stay linked to the business, whether it's to be on the board of directors or as an advisor in either a less formal and informal capacity or in a formal capacity as a consultant, which may also be part of the buyout as far as compensation goes for that individual owner that gets out. But yeah, I mean, there's a lot of self-reflection and that goes into on the front end. And I would say a lot of times that happens before you get to the LOI process, but I also see it happen when you're in the midst of it, where you're having that kind of seller's remorse. And it comes out of, you know, you don't know, it just bubbles up and it hits you sometimes. Sometimes it's something that you were already feeling before, and it just kind of got to a point where, oh, wow, this is getting real. And so others embrace it and they will say, okay, let's get this over with. I've been thinking about this for a long period of time, which we see happening these days for a couple of reasons. One is, and I'm kind of tie it back to COVID, which is that, and it has a mixed effect. On the positive side, as far as moving forward, people have felt bottled up, and so they have felt delayed in their planning and their succession planning, and whether it's to sell or through you know, to transfer to a child or to adult child or to key employees, whatever it may be. The flip side of that is, well, I feel like my business isn't as valuable as it was pre-pandemic. So let's wait and see what happens. And now inflation is increasing. I'm having all these issues. So I don't want it to sell at a discount. So let's see what's going to happen with that. Others believe that they need to sell sooner than later, so the sale price doesn't continue to go down. And there are people out there, companies out there that are, and I hate to say this, taking advantage of that, but that's what's happening. They have the money, they have the ability, they have the need, and so they're grabbing these companies. And so, you know, the sellers have to be happy with what they're getting and move on. But some are hesitating, some are pushing forward. It just goes across the range. But again, back to the psychology of it, and you know, is this something that you really want to do as a business owner?
You guys hit really the important stuff on that, which is, what do you want to do? And make choices, you know, at least be thinking about that before you get thrown into the tailspin of an opportunity or rush, somebody's knocking on your door and they want an answer now, et cetera. But I want to go back to that structure question, Adam. Like if you're structured as an S corp, and okay, you're in technology, and chances are somebody's going to come in, private equity in particular, or strategic from the outside. You've been milking this thing from an S corp standpoint, from the tax advantages. How much time do you need to actually be able to flip and move to a C corp or whatever, and partnership, whatever?
I mean, if you want to do, like, again, using that scenario, like if you're looking to do, have a tax-free transaction and you're willing to pay some taxes because you're a C corp on the way, the holding period for that is 5 years. I mean, there's kind of, a little bit of sticky, there's a little bit of fungible areas where you can say, hey, it is part of my S corporation time period, count towards that 5-year holding period, but meaning you have to be a C corporation for 5 years. And the answer to that is most of the time, no. So this just further highlights, at a minimum 5 years out.
Okay.
I mean, in other words, like if you're already within the 5-year window, you still ought to be talking, like, don't throw your arms up, but, at a minimum, 5 years out, because that, if you manufacture something you otherwise will qualify for tax-free, or even a tax deferral scenario, and the C corporation is an attractive option for you, you need to get trucking on that, sooner rather than later.
And I had mentioned a couple of weeks ago about a client a franchisor client that has expanded significantly in a very short period of time. And back to that, let's just do the same as we did before on their own. And I think maybe they had consulted their CPA firm somewhat, but didn't give them the details, which I had knowledge of. And then so they said, okay, they formed these new entities earlier this year or at the end of last year. I was told by the client that they were in the process of filing their S corp elections, and alarm bell goes off because I had put together their enterprise map, and in anticipation of potentially there being something down the road, either in the near future or far future, depending on how things go, of an ownership transaction, transition, whether it be to private equity, whomever. And for the same reasons that Adam was talking about, which is, the 5-year holding period of a C corp, do we, first of all, some of them were filed as corporations, some of them were filed as LLCs. So you have potentially the partnership issue that we need to deal with. But I said, let's put this on hold for a second. Do not file those elections. And let's discuss this. Let me discuss it with your CPAs, because I knew that there was this. Now, if they think that they are out, the owners, and I had a very candid conversation with them. I said, what do you guys want? And they said, we're not sure, because they didn't know what opportunities are out there. They know that people are interested. They get solicitations all the time, which is totally expected based on where they are, what they do in the industry that they're in. And so you have private money that wants a piece of it. But if it's 2-3 years down the road and they know that there's no way it's 5 years, this doesn't make sense for them. But if they know that, okay, they want at least the possibility, the opportunity 5 years from now or so to get favorable tax treatment for these new entities in a transfer transaction, then we need to be going down a different course, specifically not doing the S corp election. And so we did take a pause. We kind of brought everyone together and said, okay, this is what the intentions are. And so we're taking a different pathway. And I asked again, I said, okay, is this a 2-year, 3-year, 5-year thing? I said, we want to keep all options open. Because you do have, for those 5 years, you have double taxation. So there's benefits and detriments on both sides, and but you have to take a step back and consider those things rather than jumping in with blinders on. Like I said, same as it was before, and let's just do it, and then let's deal with the consequences later. Because in certain circumstances like this, you can give yourself a better result if you know at this time what you want to do moving forward.
All right, as we close up shop for today, a question that this client asked us yesterday was, they started with a statement, we're seeing some commercial lenders starting to pull back and blah, blah, blah. We're starting to see some softening. What are you guys seeing? And my response was, it depends on what sector. If you're importing a bunch of stuff, especially from China or wherever, you're hurting. Just, if you got no goods on the shelf to sell, you're hurting. And so Stephanie, who was on that with me, she goes, yeah, anybody importing is really rough. And when I was in this insulating glass manufacturing company, we didn't feel the effects of 2008 until 2011. 3 years later, then all of a sudden, banks called the notes then. I mean, it was dire 3 years later. They thought they had made it through, but they hadn't. It just was a very delayed thing. So real quick question to you, Adam and Jack. Are you seeing areas that, besides importing, exporting, that are showing slowdowns?
Sound underwhelming, but no, not really. I mean, had a couple people that kind of threw in the towel and just said, COVID beat me. But I mean, they weren't doing super awesome before either. This was just the thing that,
yeah,
unfortunately put it over the top for them. I mean, they weren't super healthy going into the pandemic. So the pandemic just put them down. It was too much to hang on. So I haven't seen anybody healthy start to get disrupted other than what you just highlighted, supply chain issues causing some order backlog, higher prices, trying to figure out how to handle price increases, stuff like that.
Yeah, and I would say that kind of the same, which was unexpected. I thought there would be more impact, larger impact. I would say that those companies that are in goods, manufacturing, distribution, retail are having a more difficult time than those that are in service industries. And that's in putting aside labor issues and other things, but just as far as providing services and generating revenue, it's because service companies are more in control of the variables. When you're a goods provider, you're very dependent upon other people, and those other people up the chain are having difficulties. An interesting Band-Aid at the time, which has started to come back and hit manufacturers and distributors and retailers of goods, more so the manufacturers, is that because boats were stuck on water, they had to find different ways, more expensive ways. And I don't remember if we talked about this here, having kind of like a deja vu moment, but maybe we did, maybe it was a different conversation. But so the fix was, let's put the stuff on a plane and fly it over. Okay. And so now what's going to happen with all that, and to fulfill orders, right? So you have now planes coming in, fulfilling orders, and then you have this stuff that was sitting on ships and now is coming in, it's trickling in. So what do you do with that excess inventory? With companies, for example, that were kind of more just-in-time type operations, where they don't put stuff on container ships until they have an order and they know what the gestation period is, the transportation period is to get it into the hands of the ultimate customer in the United States. And so now they had to modify that. What are they going to do with the stuff? So they're building inventory here in the US, which then it may be good for us in the US, but then on the manufacturing side, they're going to have to now tool down their manufacturing over there. So what impact is that going to have on the global economy? You may say, okay, well, the Italians and the Greeks, they got to slow stuff down. We got our stuff over here, no big deal. But the reality is that all of those things have a global impact on all of us at some point in our wallets and in our budgets and in what we can and can't do, what we can and can't get on the shelves.
This is good stuff. Thank you, guys. We will reconvene next week for week 114 and examining the anatomy of a deal. That sounds like a good series. I like that. And so we'll plan on that. Next time, you guys bring some more questions. But thank you for joining us. We really appreciate it. We will put this up on the BGW CPA YouTube channel this afternoon. So thank you guys for showing up. As long as you guys keep showing up, we'll keep doing it. And as long as we provide value. So thank you again. Jack, great to see you again. Adam, great to see you as always. You guys have a wonderful rest of the day and rest of the week.
Thank you.
All right.
You too.
Bye.
Bye-bye.